Everybody's heard the stories about early investors who got in on the ground floor of companies like Amazon or Tesla and made a fortune. But what if I told you that for most people, the promise of buying pre-IPO shares or even IPO shares doesn't look anything like those success stories? And what if there's a side to pre-IPO investing that's rarely even talked about? One that could actually leave you worse off than when you started.
Coinbase stock crashed on the first day of trading.
Let's get back to Robinhood. Of course, the big news was the 9% of the workforce layoff that we had a few weeks ago.
For nearly the entire history of Palantir being an investable company, the only thing the shares of the company have done is pretty much gone down.
Today, we're gonna explore why the reality of pre-IPO investing is a lot more complicated than the hype suggests. It's not just about getting in early. It's about understanding what actually happens behind the scenes. Private equity, inflated prices, insider advantages. There's a whole system at play here, and most people don't realize it until it's too late and they have a bunch of money invested. So let me save you some money in this video. And just so you know, for the average investor, it's often a lose-lose game. And let's start with why pre-IPO investing sounds like the dream. I mean, even when I first heard about it, I was like, yeah, why wouldn't you invest on the ground floor or even before it comes on the market, right? And when you hear about companies like Facebook, Google, Tesla, all of these names on the screen, you think of getting in early and watching your money multiply by thousands. Like imagine like a 10,000x investment on, $10,000. Yes, life-changing money. And yes, those stories do exist. There are investors who bought shares of Amazon, Uber, Tesla before it went public and rode the wave to massive wealth. Let's even look at IPO prices. Amazon IPO price of 7 cents a share in 1997, now around $180 to $200. Tesla IPO price of $1.28 in 2010, now over $300 a share. And Google IPO price of $2.50 in 2004, now over $160 a share. And so it's obviously easy to look at those numbers and get swept up in the possibility of being part of the next unicorn, being a part of a company that not only changes the world, but makes the early investors incredibly wealthy. That sounds awesome. But here's the problem. Those are the exceptions, not the rule. And for every Amazon or Tesla, there are hundreds of companies that either fall really hard after going public and sometimes into bankruptcy, or maybe not even make it to the IPO stage. And look, I totally get it if you want to invest to stocks like SpaceX, Fundrise, Stripe, Klarna, but it's a very high risk and somewhat low of chance for that high reward that you're looking for. So let's talk about how the game is really played. You see, the vast majority of pre-IPO opportunities are structured to benefit private equity firms, venture capitalists, and insiders, not people like you and I, aka retail investors. These early investors get in years before an IPO, and in most cases, years before a pre-IPO, in early seed rounds for pennies on the dollar, often at 80 to 90% discounts compared to what retail investors will eventually pay, even at pre-IPO. Now, think about it this way. Private equity firms invest when companies are still startups, taking on the highest risk. I mean, who in the right minds would want to take on the highest risk on a company that would likely go bankrupt? But in exchange for this high risk, they get in at incredibly low prices. And by the time the company's ready to go public, they've already seen their shares appreciate hundreds, if not thousands of percent. And that's when the company looks for its exit strategy. For these firms, an IPO or pre-IPO is often the exact time they start cashing out. They sell their shares to others at much higher prices and don't have to wait and hope that the IPO goes smoothly. For example, private equity invested in Uber in 2013 at $3 a share. By the time it IPO'd in 2019, it was priced at $45 a share. That's over a 12x opportunity. And it's no wonder why people think it's a good idea to get into pre-IPOs. The IPO basically marks a transition from private hands to public markets, right? But here's the kicker. The private investors have already made their money, and now they're looking for you to buy their shares at a premium. So who's really benefiting here? Well, when a company gets close to going public, there's usually a huge amount of hype, You've probably seen it. Everyone's talking about how this is the next big thing. It happened with Reddit. It happened with Tesla. It happened with almost every IPO, especially when it comes to tech. Financial media, investment influencers, and even the company itself create this frenzy to build excitement. Hell, I've even made IPO videos on my channel before. But hype is not the same thing as value, and I try to make that very clear in my videos, but also, it's an important thing to know. You see, the initial IPO price is often inflated because everyone wants a piece of the action. People see headlines, they get FOMO, aka fear of missing out, and they jump in at whatever price the market offers. And the result? Well, a lot of people buy at these inflated prices only to watch the stock plummet quickly after the initial excitement fades. We've actually seen this pattern with companies like Coinbase, Robinhood, and Snapchat, and hundreds of others, where the stock skyrockets on day one, but crashes soon after. And that's not a good bag to hold. And the crazy thing is there's actually a real reason why IPO stocks tend to tank after the initial surge. In the biz, it's what's called the lockup period. This is the time, usually about 6 months after an IPO, when insiders and early investors are finally allowed to sell their shares. So once that lockup period ends after the 6 months, you often see a wave of these insiders saying, all right, time to sell my shares that they've been holding on to for years. And now they finally want to cash out and have the opportunity. And that sudden flood of shares hitting the market pushes prices down, sometimes really significantly, to the point where things look cheap. And in my personal experience, is actually the right time to get in if you believe in the future of these companies. And in a lot of cases, those prices are cheaper than you would have gotten in pre-IPO. Again, not in all cases, but definitely in a few. So not only are you buying at inflated prices, thanks to the hype, but 6 months later, early investors are dumping their shares, causing the stock to drop even further. And for retail investors, this is a double hit, buying high and then watching the stock sink. So when is the best time to buy IPO stocks or pre-IPO stocks? Well, usually not at the IPO itself. One of the best strategies is to wait until the 6-12 months after the IPO, when the hype has settled and the stock price has adjusted to reflect its real value. And in some cases, even if there's some bad press that doesn't really affect the longevity of the company, or in certain cases, if you do get in early enough and at a well below fair value at a seed round, then maybe it's worth it. But again, that's really, really hard to get access to unless you have millions of dollars. And even then. For example, a study by the National Bureau of Economic Research found that IPO stocks underperformed the broader market by an average of 18% in their first year. Take Coinbase again as an example. After the hype settled, its stock price dropped dramatically. If you would have waited 6 months, you would have bought in at $250 instead of the initial $381. And if you waited a whole year, you could have gotten it at $33 a share at the low, which was a fraction of the IPO price. And now you'd be sitting pretty at over 5-6x gains if you would have bought near the lows, versus down over 50% if you would have bought at the IPO price. I mean, sure, you could have held them on for years and maybe cashed out and made money, but all that waiting is opportunity cost, and in fact, opportunity lost. And here's another thing that most people don't even realize. Many pre-IPO companies never even make it to the public markets. In fact, according to CB Insights, 70% of startups fail before they even go public. Sure, that might not sound like all of them, and it's not. But imagine throwing $50,000 into a stock that you researched and believed in, and something out of the ordinary happens. At least on the public markets, you would usually still have plenty of opportunities to sell off, since these stocks are way more liquid. And that's the reality. If you're betting on a pre-IPO stock, there's a high chance that the company won't survive long enough to ever give you an exit, which means your investment could go to a big fat zero. So while pre-IPO investing might sound glamorous, it's one of the riskiest moves an average investor can make. Hell, it's even a risk for big firms, and they have money to throw around. Now, I'm not saying pre-IPO investing is all bad. For those with the right connections, access, and risk tolerance, there are success stories. If you had invested in Google or Facebook during the private equity rounds, you'd be sitting on massive gains today. Maybe you could even retire early. But for the average person without insider access, these opportunities are few and far between. And in fact, you'd almost never find them early enough unless you know a guy that knows a guy that knows a guy that knows a guy. At the end of the day, pre-IPO investing is a high risk, high reward game where the odds are heavily stacked against retail investors. And remember that the real winners are private equity and early insiders. So before you jump into the next hot pre-IPO deal, your reminder is this: the best window to buy IPO stocks is often 6 to 12 months after the hype fades, when things actually seem kind of rough. Again, maybe there was some kind of bad news article written about the company, or some speculation that they were doing something bad. And in a lot of cases, they just pay a fine and get on with business as usual. Meanwhile, the stock is down 60, 70, 80%. But look, I'm not saying, and I'm not trying to discourage anyone to not buy pre-IPO stocks or even IPO stocks if you know what you're doing and have serious conviction and data backing it up, because you can make some serious cash doing so. And if you want to check out exactly how you can actually do that, I made a video detailing exactly how everyday people can buy shares in stocks pre-IPO. And if you found this video valuable and you want to see more videos like this, hit that like button and subscribe, and hit the little bell so you never miss a video for more content that helps you make smarter financial decisions. And I'll see you in the next one. Peace. Oh, also, YouTube thinks you'll enjoy one of these pieces of content. Anyway, bye.